Rachel B. Layola, assigned to report Biweekly 1.1 entitled Basic Concepts of Financial Statement Audit. Let's begin with the first requirement, which is to prepare audit adjusting entries. For number 1, the cash account included equipment acquisition fund amounting to 60,000. Equipment acquisition fund must not be included in the cash account because that fund is already allocated to purchase capital equipment. Therefore, our adjusting entry for number 1 is that we need to debit equipment acquisition fund 60,000, credit cash 60,000. For number 2, a physical inventory taken on December 31, 2018 revealed goods costing 600,000. In other words, it is called as ending inventory 600,000. However, it is stated in number 3 that goods purchased under FOB shipping point and verified to have been shipped by the supplier on December 28, 2018 were received and recorded by Clarity on January 4, 2019, 50,000. When we say FOB shipping point, this means that the buyer should record an increase in inventory at the point of departure from the supplier's shipping dock. Therefore, our total ending inventory as of December 31, 2018 is equal to 650,000, while our beginning inventory is amounting to 584,000. Since our purchases was increased by 50,000, the purchases for December 31, 2018 is equal to 2,474,000. To get the cost of goods sold, we need to add beginning inventory and purchases less the ending inventory. So 584,000 plus 2,474,000 minus 650,000 is equal to 2,408,000. Hence, our adjusting entry for number 2 is ending inventory 650,000 debit. At the same time, cost of goods sold amounting to 2,408,000 credit, purchases amounting to 2,474,000 and beginning inventory 584 credit. For number 3, since again it is FOB shipping point, the buyer now has the obligation to pay for the goods. So our adjusting entry for number 3 is that debit purchases 50,000 while credit accounts payable amounting to 50,000 also. For number 4, the allowance for doubtful accounts should be adjusted to 5% of accounts receivable. So our accounts receivable is 615,000, then it will be multiplied by 5%, the total of 30,750, less by the previous allowance for doubtful accounts, which is 21,000. So our adjusted allowance for doubtful accounts is 9,750. Hence, our adjusting entry for number 4, debit doubtful accounts expense 9,750, credit allowance for doubtful accounts also 9,750. For number 5, the company purchased 100 shares of its 100 par value ordinary share capital for 30,000. the amount having been charged to the investment account. Since it is charged in the investment account, so our adjusting entry for number 5 is that we need to debit treasury shares 30,000 while credit investments 30,000. For number 6, except for equipment purchased on June 30, 2018 for 20,000 cash, all equipment were acquired at the inception of the company 3 years ago. Depreciation for 2018 has not been recorded. So, the company's total equipment acquired at inception is equal to 382,000. This is the sum of the furniture and equipment and miscellaneous equipment less by the equipment purchased on June 30, 2018. Then, to get the accumulated depreciation, we need to divide 382,000 by 5. 5 is its useful life. Therefore, 382,000 divided by 5 is equal to 76,400. Then 76,400 will be divided by 2 or half of the year since it begins on July 1 up to December 31, 2018, which is 6 months. So 76,400 divided by 2 is equal to 38,200. To get the annual depreciation rate, we need to divide 38,200 by 38,200, which is 0.1%. The depreciation for the beginning is equal to 38,200, while the depreciation of the new is 1,000 because 1% multiplied by 20,000, 20,000 is the amount of the equipment purchased on June 30, 2018, multiplied by 6/12 or half of the month. So we need to add 38,200 by 1,000 as the total depreciation for the year 2018. Therefore, our adjusting entry for number 6, debit depreciation expense 39,200, while credit accumulated depreciation 39,200. For number 7, prepaid expenses include 4,800 insurance premium on a 1-year insurance policy taken on October 1, 2018. So the company paid 4,800 in advance for insurance premium on a 1-year insurance policy. Thus, 400 a month. 4,800 divided by 12 is equal to 400. However, there were only 3 months incurred from October up to December. So 400 times 3 is equal to 1,200. Therefore, our adjusting entry for number 7, debit insurance expense 1,200, credit prepaid expense 1,200. For number 8, unearned rent income on December 31, 2018 amounted to 10,000. It was shown in the company's trial balance that the unearned rent income is 12,800. However, it was found out in the given information that the aforementioned is only amounting to 10,000. So we need to subtract 12,800 by 10,000. Therefore, the unearned rent income is equal to 2,800 debit, credit, rent income 2,800. For number 9, accrued expenses on December 31, 2018 amounted to 54,000. The recorded accrued expenses of the company's trial balance is only 51,000. However, it was discovered in the given information for adjustments that this amount to 54,000. Therefore, we need to add 3,000 or credit, accrued expense 3,000, debit, miscellaneous expense 3,000. Now let's proceed to the second requirement, which is to prepare a working trial balance to facilitate the preparation of the financial statement for the year ended December 31, 2018. Flashed on the screen is Clarity Company's working trial balance for the year ended December 31 with columns comprising trial balance, adjustments, profit or loss, and financial position. For the trial balance, we just need to copy all the given accounts title and its corresponding amount. With regards to the adjustments, we write down the amount of the respective accounts from the prepared audit adjusting entries. However, if that particular account was not already in the account's title, all we have to do is write it down in the account's title column after the total of the trial balance, like equipment acquisition fund and up to insurance expense. So the total of the adjustments is amounting to 3,253,950. On the other hand, profit or loss column starts with sales, excluding purchases, equipment acquisition fund, inventory, and treasury shares. Combine trial balance and adjustments like grant income, 48,000 credit under trial balance plus 2,800 credit also in the adjustments. Therefore, in the profit or loss column, grant income is amounting to 50,800. Profit or loss debit total is 3,162,150, while credit is 3,550,800. To balance, subtract 3,550,800 by 3,162,150. So we have 388,650. Add it on the debit side or whichever is lower. That 388,650 is what we called as profit before income tax. After the partial total of the profit or loss, we need to add profit before income tax to the credit side with same amount. Then 388,650 will be multiplied by 30% based from the gathered information for adjustments, and this amount to 116,595. 116,595 is our income tax expense. Then 388,650 subtracted by 116,595 is equal to 272,055. 272,055 is the profit. For the financial position, combine and copy the amount of all assets, liabilities, and owner's equity, including income tax payable in the credit side, same amount with tax expense, also profit. So, the total of the financial position column is 1,974,800. That would be all. Thank you. Keep safe and God bless.